Hello. So we wanted to welcome you to module 1 of this workshop by first kind of opening our eyes to the structural problems of the global economy. Jump to the next slide. We're actors in an economic system that is structurally dependent on growth. And there are examples of where that system has delivered very well for us. There are certainly fruits to that growth. For example, we've certainly done a lot to improve life expectancy around the globe. We've made advances in maternal health and literacy and education. And many have acknowledged that those fruits of growth have really come about because we've invested in our collective institutions like healthcare and education. But as some folks that we've been really influenced by, particularly Catherine Trebek with the Wellbeing Economy Alliance, it might be time to consider whether the fruits of that growth are beginning to rot. And we've convened this workshop in part because we believe that in some ways we're kind of fast tracking ourselves toward an unsafe future. Today's financial system privileges and rewards growth at all costs, which is a key driver of a wide range of environmental problems, from climate change to the growing number of marine dead zones and collapsing fish stocks, which has massive implications for world hunger. And the system is also one that reinforces inequality. The fruits of this growth have been pretty unevenly distributed. It's a system that has done little for those who are suffering a great deal while enabling wealth to accumulate to those who have access to it. These stark inequalities are what Pope Francis continues to call our attention to. They're getting worse in almost all parts of the globe. In 2016, the richest 1% owned as much wealth as the rest of the world. And one of the biggest problems with inequality, of course, is that it can be self-reinforcing. So inequalities of income and wealth translate into inequalities of power. And this is problematic in the ways that it creates divisions along race, gender, class lines, and between generations. So when we don't have any growth, it's harmful. But at a certain point, the benefits start to tailor off. And if we keep reaching for more and more growth, we are likely to do really serious damage to ourselves and the planet and society at large. And this leads us to a place of what we wanted to call attention to, this concept of failure demand. It's a concept that's been spearheaded by the Wellbeing Economy Alliance, and it refers to the extent to which so much of what we're spending money on today is to fix or repair or patch up the damage that our growth-obsessed system is doing to people and planet. So things like tax credits or income supports for people who don't have livable wage jobs, or the remediation that we spend money on after oil spills. We'll jump to the next slide. What we know is that in some ways, the environment has basically set a clock for us when it comes to economic transformation. We have less than a decade to bring about the kind of economic transformation that would put us on a path toward a livable future. Every additional degree of warming does bring greater perils with it. More adverse weather impacts, flooding, heat waves, worsening droughts, accelerating sea level rises that threaten humanity and our flourishing. So we wanted to go through just some simple carbon math here. The international consensus is that beyond a 2 degrees Celsius threshold in warming, these consequences will become ever more perilous for people and planet. It's something that Pope Francis has really called us to acknowledge through his writing on things like Laudato Si. But the remaining budget before we exceed that, we estimate to be at about 225 gigatons of carbon. Currently, we're emitting about 35 gigatons a year. So again, you can do the math there, right? We have less than 10 years before we exceed that threshold. It's probably closer to 7 or 8. What's really quite mind-boggling to contemplate is this last number here, roughly 2,600, gigatons, which is the number of the total proven oil reserves embedded in the balance sheets of oil companies. So if we jump to the next slide, you can see here this list of oil companies. For example, this first one, ExxonMobil, the stock price at the end of last year was about $42. And their market capitalization here of about $176 billion, embedded in that is the future production of those proven reserves that I referenced earlier, the 2,600 gigatons of reserves. So there's a disconnect here, right? When you add up this sort of total market capitalizations and you get to that 2,600 gigatons in proven reserves, we are definitely going to vastly exceed a budget that's within the safe realm of a livable future. So while there's no going back from some of the changes in the climate system, we can take actions that really do make a difference for us in the future that's ahead of us. Jump to the next slide. This is part of a larger problem of the way that our financial system is currently disconnected from reality. So in this growth-oriented system focused on GDP, we estimate that global GDP is about 75 trillion. But according to McKinsey, when you add up the total global debts and equities in our market, we have about 212 trillion in estimates, which means that we have claims on about 3 times our estimated global GDP. So just let that sink in a little bit. What's even more mind-boggling is that when you add up the total global national value of derivatives, basically our financial markets, that's about 1,200 trillion. That's 16 times GDP estimates today. So each one of these dollars, in a sense, does have a claim on some kind of physical good or service that we might see as constituting global GDP. So what is this kind of artificiality in our system that we're swimming in? Another thing to contemplate is this concept of natural capital. So there have been various attempts to try and quantify just how much natural capital we have across our globe. And there are all sorts of kind of different ethical questions and dimensions to that work. But in essence, what we wanted to drive home here is this idea that because of our current system of commodification of goods and services, we basically are swimming in a world where a tree is worth more dead than alive. So how might that kind of shape our concepts around GDP and perceptions of economic growth? And finally, we think that this all kind of adds up to really challenging our sense of capital market expectations and the future of where we're headed. So I'll turn it over to Felipe to dive in there.
Marco Evangelisti is one of the teachers that Elizabeth and I have learned from, and he offers a wonderful course called Toward No Harm in Value-Centered Investing. And a lot of his thinking is represented in the slides that I will go into now, that just kind of takes what Elizabeth shared into a particular example of monetary policy in the United States. So this is the federal funds rate over the past 60 or so years. And you can see started around 4% in the 50s, and then went up to around the 1980, almost 20%, and then how we've had this dramatic decline over the past 30, 40 years, and basically this unprecedented low 0% interest rate environment for the past 10 to 15 years. And so what does the Fed have as options? It can only go up from here or continue along this unprecedented cheap money. And there's all kinds of other impacts that this has on the economy with corporate share buybacks, leverage, the carry trade. There's many challenges, but I'm going to talk about just the balance sheet of the Federal Reserve recently. For many years prior to 2008, we had about less than $1 trillion, about 840 billion on the balance sheet, as you see here. And then with the financial crisis in 2008, you see the dramatic action taken by the Fed. And then through 2008 to 2014, mortgage-backed securities, treasuries purchased to the tune of about $3 trillion. Now, $3 trillion, for perspective, is about the total value of all US farmland. So imagine all the acres in Nebraska and Kansas and the Dakotas, all of that add up, the total value of that adds to $3 trillion. And that's how much the Fed had to insert into the economy just to kind of stabilize things. What's even more surprising to me recently when I looked was when you take a look at what happened in 2020 at the beginning of the pandemic, mid-March, you see this dramatic $2 trillion added in the immediate 30 to 45 days after the shutdown occurred, and then the continued quantitative easing over the past year and a half. And cumulatively, we're added about $8 trillion to the balance sheet. And just for perspective, if we had all 31 million frontline workers in healthcare, grocery industries, transportation, each one of those workers, those 31 million, would be $250,000 that they could have, just to quantify what 8 trillion means in terms of quantitative things. But what it caused in financial markets is when you have this buyer with unlimited funds, you have an opportunity to prop up kind of financial markets. So here's the S&P 500 forward looking thing, the dark purple line here. And then the red line is the Federal Reserve's balance sheet. And so you see here right at the middle of March, when the shutdown, the crash occurred and occurring with the shutdowns, you see the high correlation with the purchasing. So you see basically what's happening in financial markets. What's more difficult to kind of comprehend is the disconnection that occurs now. So the earnings per share ratio, this NASDAQ red line here, has consistently been thought of as a good barometer for the stock market. So you see how closely correlated it is with the NASDAQ prior to March 2020. And then as the earnings per share goes down with kind of a more real metric, economic reality in some ways, the NASDAQ actually goes up because of the Fed action. So the Fed is contributing to this disconnection that we think is occurring, and you can see in many other places, as Elizabeth was pointing to earlier. Now, to take a step back, part of our job as asset stewards is to imagine what's going on in the future. And conventional wisdom often looks back at previous historical rates of return to project forward what the next 20 years might look like. So in US equities here, we have the 20-year estimate from Fidelity at 6.6%. You can see how close that is to the 6.8% historical rate. Same thing with investment grade bonds or other equities here. They're closely correlated to historical thing. The question we want to ask is, this conventional wisdom make sense to you? Does this rear view mirror, looking back, given this natural capital accounting problem Elizabeth mentioned, where Marco estimates $7 trillion has been converted from trees that are alive to dead, and now they're in our GDP, and that's contributed to growth over the past. Do we think, how much longer can that continue? And so we want to just help you increase your own confidence in your own ability to make some of these judgments. Now, GMO, as an asset steward out of Boston, Jeremy Bent is the CEO there, and he's one of the founders of one of the first index funds in the 70s. They take a provocative view on their forecast. And this 7-year asset forecast kind of projects real returns. So how do you look at this? So you read a negative 6.7% return on US large cap equities. That means that every year for the next 7 years, they estimate that on average, US large cap stocks will fall by 6.7%. So in other words, about a 45% overvaluation in current equities, and similar for bonds. So this is a provocative point of view for those of us who have experienced the growth in the past few years, but I want to kind of challenge you to think critically about your own forecasts. And ask the question, is looking back the right way? Is this rear view mirror approach that we tend to take in financial markets with our capital market expectations? So we talked about this unlivable future problem with the simple carbon math. We know there's this disconnect with oil company valuations, and climate risk is just not priced in these realities. We saw that unprecedented shift in interest rates, the current environment. We talked a little about the quantitative easing and the perspective and just the mind-boggling orders of magnitude entailed. So what's your best thinking on where the system is headed? What could your deeply faith-grounded perspective offer to help reshape the system and the potential trajectories we're on? So we'll close with just kind of these problems that we're lifting up in economy and finance. And I'll turn it back to you, Elizabeth.
So I think Felipe's point about reshaping our trajectory is an interesting one in response to an invitation Pope Francis has shared, which is to become a protagonist of transformation. So I think what we want to leave you with is this notion of, what kind of transformation are we seeking? Who and what do we want the economy to serve? What is the economy? The original Greek meaning of the word economy is household. So what kind of household are we cultivating for ourselves, for our communities, future generations, and for our global planetary home?